Now, having stated different types of accounting, forensic accounting, sustainability accounting, fiduciary accounting, fund accounting. We have tried to explain a lot of them. Now, we now look at the characteristics of financial statement. That is how to go about preparing and presenting financial statements. Financial statements have the following account or statement in them, like statement of financial position, statement of P&L and other comprehensive income, statement of changes in equity, so say, then notes to the financial statement. For a financial statement to be termed complete, it must have the following characteristics or features. It must be relevant. If you prepare and present a financial statement, it must be relevant. That is, it must make a difference when put in use. For anybody to be relevant in the society, the person must have made a difference one way or the other. That is, the person must have affected some decision making. Like I am relevant right now. Most of my students see me as very relevant because they can use me to get knowledge in different fields of accounting, IT, computer technology, business, social, political, and even spiritual. So when you talk about spiritual, we're talking about, you know. So they see me relevant in that area. They seek counsel and the rest. They seek my decision on things, on the economy, on their investment, and so on. Progress, to gain prosperity and the rest. So, financial statement must be relevant. It must be faithfully presented or represented. Faithfully represented. That is, the report must show true and fair view. The information you get from preparing or the presentation of financial statement must be faithfully represented. That is, the transactions, the activities that is in that financial statement must be faithfully presented. Faithfully presented. You don't just, bring irrelevant items. There must be relevant phenomenon, events that relates to making good decisions. That is number 2. It must be complete, adequate. You must explain every information that be derived from a financial statement. Whoever is preparing or presenting must be neutral in your presentation of the financial statement. You must be neutral. And neutrality brings completeness. You must be free from bias. These are the things you see in a financial statement that makes a financial statement a sound one. Now, what is it that can enhance these characteristics? That's another subtopic. What can enhance the characteristic that I've mentioned now? One of the things that can enhance it is comparability. You must be able to compare one period with another. This is a qualitative, what is it called? Characteristics of a financial statement. There must be comparability. You must be able to compare one period to another, like 2025 and 2026, 2023, 2024. And what will enhance it again, number 2, is verifiability. You need to be able to verify most of the figures there. Someone cannot verify your figure will be dull in assessment. It will be dull in assessment. Another thing is timeliness. It enhances the completeness, the faithful representation of financial statements. It enhances it. Timeliness. Timeliness. Like when you are expected to, present your financial statement of last year between, let's say, January to June, you end up presenting it in 2027. Financial statement of 2025, you are presenting it in 2027. What is that? What is that? So financial statement must be timely because it must be used for decision making. So if possible, your financial statement by March should be ready. By March, it should be ready. All things being equal. Nobody is saying January. March, because of a lot of adjustments we do in accounting. There are a lot of adjustments that we do in accounting. So it must be timely for decision making so that you can file your account with CAC and FIRS. Another thing is understandability. Understandability it must have the ability to be understood when the information is derived from them. If you present such information, it should be understood. That's why you see some audited account, they will put some good charting, graphs, and all the rest to explain some information. And you see some standard stated under notes to the account and assumptions and the rest and disclosures are made to all the statements of position and the rest that you can find in a financial statement, even director's report, auditor's report. All of them is to do what? To make you understand a financial statement. Now, you want to look at the principle of coding. What do we mean? The principle of coding in financial accounting. Coding is a process of recording data. Data that we collected, we record them in books of accounting. So this process will help us to do what? To classify we use different types of method to carry out coding of transactions and financial data. We can use alphanumeric. Alphanumeric sometimes is when we talk about letters, and numeric when we talk about figures. We can use like SW to represent some transactions, and that SW can be Southwest. You can use figures, numeric, like 1,000, 101. We can combine the two, like QQ12. It's just to be able to do what? To identify such processes. And those coding is actually looking at places, services, activities, journals, ledger, account codes, particularly when you are looking at accounting softwares. What does it help us to achieve? What does coding help us to achieve? It helps us to achieve uniformity. When you talk about Northwest, everything that relates to Northwest, you have NW 001, 101. Because there might be branches in Northwest. Like Kanu, Kaduna, all these places can be said to be Northwest. North Central, NC, can have Zamfara, FCT, you can have Niger, Benue, Plateau, so that you can have uniformity. That is one of the objectives. And you can be consistent. That's another objective. Consistent. Then brevity. It reduces the ambiguity of long words. It reduces the ambiguity of long words. Then it is to conform to gap, GAAP. We'll be measuring gap from time to time. We'll be measuring it. Gap. What is gap? Generally accepted accounting principle. And this is the FIRS, International Financial Reporting Standard, IFRS. Most of the standards have been put together to form IFRS, and they are, gaps, local gaps that are brought together to achieve these international accounting standards. Another objective is for regulatory compliance. Regulatory what? Compliance. Data integration. I've said to remove ambiguity. So it also means it is to help or to achieve, the objective is to achieve unambiguity. If it is to remove ambiguity, it means you achieve unambiguity. That is no confusion in the system. The system can flow on a true and good process. When we look at this, you will see that the objective and the rest will give us what? Advantages. And for everything that have advantages can also have disadvantages. Are we there? Let's look at examples of a coding system in accounting. We have the GL codes. That's the general ledger codes. What does general ledger codes does? It classifies financial transactions within an organization into general ledger so that it can help us in tracking and analyzing income, expenses, assets, and liability. Income, expenses, assets, and liability. So what general ledger does is we classify financial transactions into assets, liabilities, expenses, income. Assets and expenses are always debit items, while liabilities and incomes are credit items. If you look at the board, you will see how I classify them. Debit, assets, liability. Assets are always debit items, whether it is non-current assets or it is current assets. The same thing goes for liability, the credit item, whether it is non-current liabilities or current liabilities. Then we have expenses as debit items too, and income as credit items. We will look at this where we get to our double entry principle in the course of the lecture. Then we also code our costs. Most times, cost relates more to management or cost accounting. It helps us to categorize and track expenses. Then we also have unified account codes, unified account codes structure, UACS. This is also used by government budgetary, treasury, and accounting codes. We have sector codes. Sector codes is also looking at our classification of industries and economic activity as a whole. Now, having collected data, I said we will need to do what? We will need to look at the various ways we record those data we have collected and classified. We need to record them. And in recording, we record to subsidiary books. So what you use them for, this is to record before you post to your ledger using double entry principle. So we have these 6 items that are on the board: cash book, sales day book, return inward day book. Is item that you sold on credit that your customer can return inward back to you if it's defective or it has some problem. You have purchases debut for your purchases on credit. You have return outward. It is those things you purchase on credit that you can return outward. Then you have the last one, but not the least, the journal proper or journal entry or journal voucher. We have two transactions that we carry out in an organization. One of them is cash transaction. The other one is credit transaction. Your cash transactions are those obligations you meet immediately. Those obligations you meet immediately. The payments that you meet immediately or your customers pay immediately. There are businesses that deal with cash alone. They don't give credit. It has its advantages and disadvantages. But there are. You can't go to a supermarket now to buy ice cream. Now you take 10 packs of ice cream for your children. You tell the cashier, I'll come back tomorrow to pay. They will arrest you. Because that's stealing. You know you are supposed to pay cash. So those cash transactions goes to your cash book and your cash book only. But there are some transactions you carry out from companies that you tell them you are not paying immediately, and they will give you because you have credit enablement. They have assessed you, you've been a customer for some time. Those kind of sales go to your sales day book. They go to your sales day book. They don't go to cash. So any sales you make in cash goes to your cash book. The credit goes to your sales day book. The same thing for purchases day book and return outward day book. It is items that you purchase on credit that you can return if they are defective. The journal proper deals with every other thing that is not cash or credit transaction. It could be letters you wrote to your bank that you ask them to do what? To debit your account and pay your life insurance premium on your behalf. From your account, they will pay the life insurance company and debit your bank statement. The accountant will need to do that every month or yearly, as the case may be, by having that information, the letter, a copy of the letter with him, or provided by the MD or whoever. Then he has to do a journal and debit the cash book, as the case may be, and credit the insurance company. That is the double entry. We are not there yet. But that is what you will do on Jonah. We will look at that when we get there. We will look at that when we get there. Now, cash book serves as subsidiary book and also ledger book. Every subsidiary book is a kind of memorandum recording. That is, there is no debit or credit in a subsidiary book. It is more like getting a register and be listing each sales on credit on a daily basis, each returns, each purchases and the rest, and preparing a journal, particularly for errors, for opening balances, and the rest. So they are what? They are not ledgers. It is from there you post your double entry principle to ledger account. To ledger account. Let's look at the principle of double entry. The principle of double entry. Debit and credit. I wrote something on the board previously that I said all assets and expenses are debit items. Underneath what I wrote under debit, you will put debit receiver of benefit or the account that received benefit. Credit, the account that gave out. Credit, the account that gave out. Debit, the account that received. What it means is that when your customer pays on its account, you will debit your cash book because your company is the one that received and your customer is the one that gave. We will look at double entry principle when we get there. But I want you to understand that you debit assets and expenses and credit and income. Now, assets stroke liability goes to the final account, which we call the financial position, statement of financial position. While expenses and income goes to profit and loss and OCI, other comprehensive income, P&L and other comprehensive income. I call it P&L and OCI. These are the two final accounts that is prepared by organizations apart from some other analysis like the statement of cash flow, so say, and the rest. But these two accounts, financial position and P&L, are those accounts that are called the final account, which comes from your ledger. The principle of the your ledger you have the ledger account as I have it on the board, divided into two: personal account and impersonal account. The personal account, I have about 5 of them there: receivables account, payable account, capital account, bank account, and private account, like directors, current account for directors, or directors' current account, as the case may be. The impersonal accounts are divided into two: the real account and nominal ledger account. The real accounts are the tangible assets, like land and building, motor vehicle, furniture and fittings, equipment, etc. Then we have the nominal ledger account that is divided into three. I have the revenue account, like sales, like interest received, like credit notes received. Then I have the next one, expenses account, where you look at depreciation, wages and salary, insurance, insurance expenses, admin expenses, you name it. Then I have intangible assets as number 3 divide of a nominal ledger account. An intangible assets can be goodwill, investment, it can be trademark, copyright, patent rights, etc. So those are the ledger accounts you can find, but it's not limited to this. It's not limited to this. It's not limited to this. So the tangible accounts, let me explain the tangible, or let me start from the personal account. Let me start from the personal account. Now, why it is called personal account is that you have to personalize it in the account recording. when you are recording your account, before you start analyzing it from the subsidiary book, there are accounts that you need to personalize. That is, you need to put a name to them. You need to classify it by putting the appropriate name. Take, for example, receivable. Receivable is the same thing as debtors. Those that are owing the organization. You have to put a name to them. Lagbaja is owing. Mr. Smith is owing so amount. He bought on credit. So you need to put receivable. Mr. Smith, Mr. Lagbaja, Mr. Tony, Mrs. Queen, Mrs. Lakuya, Mrs. Prole. You need to put names to them to identify them. So it becomes personal. If your company or the organization purchase on credit and they are owing, that is payable. You have to put the names of those, your suppliers that you are owing. Mr. Lagbaja, Mr. Tonimo, Miss Plalu, Miss Precious. You need to put a name to them. You don't just say, I'm owing someone or payable and no name. There must be names of those people you are owing and the amount you owe. So that makes it personal. Then we talk about capital account. Those that have those that invested in your company or the owners of the business, the shareholders, or the name of those that brought in capital. You have to state their names. Mr. John, Pastor Luke, Mrs. Pratt. For shareholders, they usually have register in their office. In the register, the organization will have register of shareholders and the amount of shares they have and their value to make up the share capital value account in the books of the organization. So, but for private companies or sole proprietors, mostly it's a one-man business and the name of Joseph Olukoye will be there as the owner of the business. That is capital account. You have director's account or director's current account, which is private account. Mostly the directors, they give out money to assist the organization. You have to open an account for them. So you have director's current account. It might not be one director. Even if it is one director, there must be a name to them. Bank account too. You have account in these banks, Zenith Bank, Access Bank, First Bank. You have to put a name to them. If it's only First Bank, you have an account. You put First Bank account. Because you just don't put bank account, you put First Bank account. So you make it personal. You see that because of the name you apply to all these accounts, that is what makes it a personal account. Now, in personal account, companies buy assets, which is divided, the impersonal account, as I told you, is divided into two. Real accounts. Real accounts are those accounts you can see and touch. You can see them and touch them. That's why we call it real accounts. Accounts you can see and touch. They are real. They are real. So land and building is an example of tangible assets. Assets you can touch and see. Motor vehicle, furniture and fittings, equipment like computers, laptop. You can easily see them. They are all real accounts. And they are recorded thus in personal account. You don't need to put a name to them. You don't need to put a name to them. Because the name they bear is the name of the company that bought them. The organization that bought them, the name is already there. We have the nominal ledger account. They are also impersonal. You don't put a name to them per se. Like revenue, sales. Don't forget that I told you credit sales goes to where? It goes to sales table. From sales table, you post to sales. Both cash and credit goes to sales account. Then you have interest received, maybe from banks, maybe from investment, dividend received. They are all revenue. Then you have expenses, depreciation. It's an expenses that you use journal entry to record and post to their various accounts. So you have depreciation account. You have accumulated depreciation account. You have wages and salary, insurance premium that you pay or accrue for. Different kinds of expenses, admin, factory expenses, marketing, sales and distribution, legal and professional expenses. They are all part of nominal ledger accounts. Then you have intangible accounts. When we say intangible, it means it is not, you can't really see it or touch it per se, but they are there. Good is part of it. We'll talk about goodwill when we get there. Trademark, copyright. You register this with your government and you pay for them. The value is what you put in your accounts with their name. Patent is meant for those that are selling medicine. Those that are actually, in the pharmaceutical, they get patent rights. Copyright for books and music. You register them and make sure that nobody copies it without your consent. All these things are intangible. Investment. They are intangible assets. You have investment in companies and all the rest. Also, some of your investors, they have investment in company and the rest, which are not loans or debentures or debt, or as the case may be, or share capital. you put them in investment. You put them in investment. So that is the